If you had $500,000 sitting in the bank, would you use it to pay off your house? Or would you try to make that money grow? That's the exact dilemma one family is facing. They've got a mortgage of nearly $500,000 sitting at a steep 6.5% interest rate. At the same time, they're sitting on enough cash to wipe it out instantly. They're not broke. In fact, they earn around $300,000 a year between them. They've got a $100,000 rainy day fund, they're maxing out retirement accounts, and their savings account alone brings in about $1,000 a month in interest. On paper, they're doing great. And yet, there's a problem. Because while they aren't living paycheck to paycheck, their flexibility feels razor thin. One paycheck goes almost entirely to the mortgage. The other covers living expenses, childcare, healthcare, car payments, insurance, and all the rest, leaving just about $500 to $1,000 at the end of the month. So here's the million-dollar question. Literally, should they use that cash to kill the mortgage today, or should they keep investing and let it compound? The case for paying it off. At first glance, the answer seems obvious. 6.5% is expensive. Paying off the house gives them a guaranteed return. There's no market risk, no waiting, no guessing. That AS like locking in a risk-free 6.5% yield, something you won to find in any savings account or short-term treasury bill. And there's more. Without a mortgage, they instantly free up $3,600 a month in cash flow. That's like getting a raise without lifting a finger. And beyond the math, there's the emotional side. The idea of owning your home outright carries a powerful sense of security. No more interest compounding against you, no more looming debt. Several people who've done it say it's like a weight being lifted. One even said that after paying theirs off, their home insurance went down slightly. An unexpected bonus. But as convincing as that sounds, not everyone agrees. The case for keeping the mortgage. Because on the other side of the debate, the argument flips. Some say paying off the mortgage too early is actually a financial mistake. Why? First, the tax code. Mortgage interest can often be deducted, meaning that 6.5% isn't really 6.5% in practice. Depending on their state and tax bracket, it could be closer to 4.5%. And when you zoom out over decades, the stock market has historically returned far more than that. In other words, if they invested that $500,000 instead of locking it into their home, they could potentially come out way ahead. Plus, keeping the mortgage preserves liquidity. Life happens. Medical emergencies, job loss, unexpected expenses. Having access to cash gives flexibility that a fully paid-off house does not. And that's where this debate gets messy. The community weighs in. Because when this family posted their dilemma online, the responses came flooding in. Some comments cut straight to the heart of the issue. One person said, "Pretend you already bought the house in cash. Would you go to the bank today, borrow nearly $500,000 at 6.5%, and then just let it sit in savings? Of course not. So why are you doing it now?" Another pushed the mental side. Imagine losing your job, getting sick, or just wanting to slow down. With no mortgage, you'd never stress about making that $3,600 payment again. But then, another voice chimed in. The market isn't predictable. Sure, it's high right now, but unless you know the future, you can't say it won't go higher. Over time, investing almost always beats paying down debt. So which side is right? The emotional equation. Here's what makes this more than just a math problem. Money decisions are never purely logical. They're emotional. Parents in particular often lean towards safety. When you have kids, you value stability differently. That $3,600 payment every month isn't just numbers on a page. It's the difference between stress and peace of mind. Several commenters admitted they could have invested instead of paying off their homes, but they don't regret choosing security. Because there's a value to sleeping at night, and you can't put that into a spreadsheet. But if you stop there, you miss the other side of the coin. The investment angle. Because right now, the family's cash is in a high-yield savings account. Yes, it earns them about 4% annually, but that's still below their 6.5% mortgage, which means their money isn't growing, it's losing ground. What about T-bills or bonds? Safer, sure, but still not keeping pace with that 6.5% cost. Stocks? That's where things get interesting. Historically, the S&P 500 has returned 7%, 10% per year on average. Over 30 years, that's a huge difference. But markets aren't predictable. Dropping $500,000 in at once could pay off massively, or it could tank right away. Timing becomes everything. So this family sits at a crossroads, guaranteed security now or the possibility of far greater growth later. The bigger picture. And here's the twist. This couple isn't just sitting idle. They're already maxing out their retirement accounts, backdoor Roth conversions, and even a 529 for their child. They're disciplined savers, which means whichever decision they make, they're still setting themselves up for long-term wealth. That's what makes this dilemma so interesting. Paying off the mortgage could accelerate their path to FIRE, financial independence, and early retirement. But investing that money might supercharge their wealth and let them retire even earlier. So, which would you choose? At the end of the day, there are only two real options. Wipe out the mortgage today and enjoy instant freedom, or hold on to the cash and bet on long-term growth. One path gives peace of mind and stability. The other offers the chance at much bigger rewards, but with more risk. So now the question is yours. If you had $500,000 in the bank, would you pay off your house tomorrow? Or would you roll the dice and let that money try to grow?